joining. It's always fun to come in on Wednesday and see what's going to happen. I'm going to jump right into it because we've got a lot of material to cover. Okay, so fundamentally, let's go through what's changed. And then I want to go through the balance sheets, and then we're going to go through the technicals on the markets, because what we're watching unfold is significant on several levels. First you've got the basic grain fundamentals, which is you have three parts, right? You have your future spreads, you have your flat price, and you have your basis levels. And all three of those are independent parts of the market, and they all have a role to play. And so what we're seeing are the basis and the spreads really start to kind of form. So the May contracts are coming into delivery starting here in the next couple of weeks, right? And so what that means is, so you've got this tension between people that may want to take delivery or deliver into the futures markets, and the role of the cash market is to make sure that that doesn't really happen. So you've got basis screaming higher. So in corn, you got basis down in Texas as much as 250 over, and or in Hereford you're anywhere from, call it, $1.50 to $2 over the board. In Western Kansas you're $1 over plus. And then what's interesting is that the bids are really getting pushed in Iowa too. Some of the soybean bids that we're hearing are as much as $1 over cash basis, and that's 50 to 60 cents above what their posted bids are. So you've got processors and end users really starting to pay up for supply, and the reason is because they're having trouble sourcing it. We're not in a market where we have enough, and then that's getting compounded by the government issues that are going on. So you've got your end users, and you got your ethanol plants and your crushers, and you've got all these kind of domestic end users that need it, and they're used to an orderly market. But now what we've also got are we've got governments from all over the world jockeying to get in and secure their supply, because they're starting to recognize that we're tight. And so how can those crushers compete with a foreign government that it's very difficult to do that. So we're starting to see a lot of that stuff happen. So I think that the May contract is could really continue to be dynamic here for a while. And so I'm going to stay in showing the May charts. We'll jump into December and we'll look at July, but I think May is kind of where we want to be for now. Now, fundamentally, some of the other things that are going on, it's been cold here. I don't think that matters. We're going to get a crop planted. But in Brazil, they've got a different issue. We've seen the good to excellent ratings on the safrinha corn crop plummet about 30 points in the last 2 weeks, from 90+% good to excellent all the way down to 60%. And so what they're telling us is that crop's in trouble. So I'm going to pull up our spreadsheet, and I want to highlight one main point here before we start looking at this, which is that this spreadsheet is based off of what the USDA is using for its South American crop, and they're expecting this South American safrinha crop to yield 85 million metric tons. So, but we know that crop's in trouble because they're in a drought, and it seems like that crop is getting worse, definitely getting worse, not better, and there doesn't seem to be a lot of relief in the forecasts moving forward. So if you look at corn, this is what the USDA says our acreage is going to be, 91.14 million acres. If we yield a perfect crop and we grow 180, and remember, we've never done that before. That's 4 bushels an acre better than we've ever done. But if we yield that, we're going to grow our balance sheet out to about 1.5. and that's up from 1.3 today. But the talk is, and all of the information, the facts, the export pace, the sales pace, the grind pace, the feed pace, you name it, ethanol grind is increasing. All of these facts point to this number is not accurate. It's actually probably 250 to 400 million bushels too high. So you can shave, call it 300 million bushels off of that. So we've been talking about the yield pressure that we have, because this number is not going to cut it. Now, if that safrinha crop is, let's call it 20% light on its production, and it drops from 85 to 65, that is, I'll do the math for you, 20 million metric tons, that's 700 million bushels of corn. So if this number is already 300 million too high, and you take another 700 million off of it because they don't grow it, then we are extremely tight, and that's what's being reflected in the cash markets, right? So you've got everyone jockeying for position to secure their supply. A trader told me this week that their work is showing that our domestic end users are less than 25% covered through August on their corn demand. And so how in this fundamental landscape an end user wouldn't have been covered for the last several months? I mean, it's just total negligence on their part. This has been very clearly happening for a while. So let's say that we get into a weather problem. Remember, this number here kills 400 million bushels worth of demand. We're out of corn. So we have to go buy acres just to manage our own supply. So if you do this math and we add close to 4 million acres, and we grow a perfect crop, and we pretend that the USDA is right, we're still not that heavy in corn. So we have to have a perfect crop with perfect acreage. So if somebody says, oh, no, that's not right, that doesn't matter, I'm going to show you a chart that begs to differ. So if anybody says corn doesn't have a problem and it doesn't need it, this chart should change your mind immediately, because this is the spread between corn and beans. So just as the acreage war started, right, we went through the planting intentions report. This is the month of February right in here, and we were at 259, 26, and we're pretty comfortable trying to say beans are, we need more beans because we're out of beans, we got plenty of corn. That's what that spread was telling us. Well, now that the March 31 planting intentions report comes out, and they said, hey, we're not going to plant as much corn as we thought, and frankly, we're not going to plant as much beans as we thought. Everyone expected beans to go buy acres, right? Because the story has been beans are out, beans are out, beans are out. So we're gonna race beans higher, and we're gonna take this spread out to 3 because beans have got to go buy acres. Well, corn reared its head up and said, no, that's not going to happen. So anybody that says corn doesn't have a problem, this chart begs to differ, because it is securing its supply. The other thing that has happened in order to defend corn, and this confused me for weeks and weeks, about why wheat, this is Kansas City wheat minus corn, okay? So typically the Kansas City wheat trades a significant premium to the price of corn. And here we have wheat at an all-time low. This is 1976 all the way back to here. So Kansas City wheat tried to do some of the work for corn in its spread by collapsing its values to put itself into the feed ration. And why did it do that? Well, because the news is pretty it's pretty well known that we have plenty of it. The world grows it everywhere. Hey, not a problem. We'll do the heavy lifting for corn. Well, so that spread has completely collapsed, and corn started the rally and collapsed this spread. So now here we are in towards the end of April, getting right into the heart of the planting season, and we've got both corn and beans apocalyptically light on their balance sheets, because you can make a very good argument that corn is negative. If this number's 400 too high and we don't get the acres and we run into any kind of a weather issue at all, you can make an argument that the United States has zero exportable corn available in its supply chain. And you also can make that argument, and we've been saying this for months, on beans, that beans also have no exportable supply because we're going to have to keep it all here. So what does the market have to do? Well, it has to rally the basis, and it has to rally the spreads in order to ration that demand and preserve the old crop supply to make this number as high as possible, because it can't accept that weather risk. So, and it definitely can't accept a 700 million bushel hit to the safrinha crop. So I'm not buying any bearish argument that we're too high at the present moment. So let's look at the charts a little bit more and continue to build out this case. All right, so here's your weekly chart of corn. Okay, I've got this zoomed out. This is 2006 back here on the left, and this is current right in here. So we're looking at a candlestick chart with no other indicators overlaid on it, all the way back to 2006. And what we've talked about for weeks is this gap. Now, if you look at different charts, it may or may not show this gap. And my software is showing it, and the reason is because it's a continuation chart. So at this week, we just happened to roll to a new month, and the collapse had already happened. So it left this giant gap. But no matter what chart you look at, there is a small gap up in this area right in here near $7. So when we broke this high right in here at 520, we immediately came to the bottom of this gap into this congestion zone. And then we spent 8-10 weeks kind of both sides of it, right? Jockeying for position to decide whether the market needed to work itself higher. And so we've clearly now broken up into it. There's very little chart resistance, guys, all the way up to the highs of 850. Maybe that's some resistance. Maybe in this range right in here we'll run into some resistance, but it's not as good as this little level here for support, right? Or this level for support. It's not as well defined. So the odds of it moving on up into this 650 range are very, very good. The odds of $7 corn coming in the next few months are much better. Now, we've talked about the potential for higher prices for a while, but we've always put a caveat on it of saying, well, the only way that happens is if we get into a big weather scare. Well, that's because we all assumed that the South American crop was real, and we've discounted the possibility of China reneging on its purchases. So some of this time period right in here was the market discounting the possibility that China wouldn't take the corn. Well, because remember, the futures market discounts the probability of future events, right? So here it's discounting some of the risks of China not buying. Well, China's taking all of its stuff. It's jockeying for more. It's doing everything it can to ensure its supply. It bought everything it could from Brazil. It's taking delivery on everything it can. Brazil's now having to import all of its grain, and that is just compounding this problem in the story on into the nearbys. And so we could see more, just extreme up, all the way up to the $7 range very, very quickly. A rule of thumb is when you break a round number like $6, and this is not science, but a rule of thumb is when you break a significant psychological hurdle like $6, you can go 10% beyond that very quickly. So that would count to 660. If we get up into 660, look what we did. We pumped right up into here, and now you're just a hop, skip, and a jump all the way up into here. So a couple other things that should be on your radar is that on May 1, remember on March 31, they increased the limits at the CME. They doubled the position limits that the funds can carry. And now on May 1st, they expand the corn limit from 25 to 40 cents a day. So higher prices beget higher prices because a 1% move moves more pennies. So it's more attractive for funds to trade. We talked about this in beans when they went into double digits. It just makes it more attractive for them. Now they've got more room to push it in a day, and they've got more horsepower and more money to throw at it because the limits are bigger. So everything is set up for the daily ranges of corn to continue to expand and move. So we're going to have down days. We're not going to go straight here. We're going to have, we could have 40-cent down days and 40-cent up days. Well, you could expand ranges from 25 to 50 to 70 cents a day in corn, like soybeans moving forward. So the message here on beans and corn is back up and go up to the 30,000 foot view and keep an eye on what is happening and where we are in the time of year. These balance sheets are extremely tight, arguably negative. It's April. We've got a long way to go before this crop is made. And so that's why we're not recommending any pricing. We just got to sit back and let this thing work. I know it's tempting to jump out and try to sell corn because, we're up like 10 days in a row and we keep going. We will get pullbacks, but there's nothing on this chart that says that we've topped. Even a reversal today doesn't negate it. Can we dip all the way back down to 491? Sure, we definitely can. But you can do that and still maintain its uptrend. There's no divergences. There's no there's nothing that we look at that says that we are oversupplied in corn to the point that we need to break this thing. So our advice is just sit tight because we need to let all these other things unfold. Beans, same thing. Beans just keep working higher. One thing I want to show you on beans real quick. If you take this trend line and you connect the trend line to this correction over here, we made the argument last week that this entire move from middle of January all the way over to here was a big correction. In a typical market, that correction would have dipped much, much deeper and retraced a bigger portion of its move. But the balance sheet is so tight, the underpinning support is so strong, it's just kept getting bought. So this break didn't end up being a break at all. It was just a big 12-week sideways pattern that frustrated everybody. But what's interesting is that if you draw this trend line, right, connecting this low to this low, and you take it all the way through, you see our resistance level that we keep having here. It's now failed 1, 2, 3 times. I think once we close above this and come back down and test it, I think beans could move explosively higher because they've got to buy acres. Remember, the balance sheet on beans is worse than it is for corn at the moment, and that spread has collapsed. So they've got to go buy acres, and a 2.4 or 2.3 is not going to do it for beans. It's got to go. They've got to go higher. And it's just, we got a little natural chart resistance right there that's tough. An example of how that resistance works is on corn. I'm switching softwares on you here for a second, but this is a Bollinger Band, and you may wonder why we had these reversal days in May corn. It's because a reason for it, right? This is probably not the only reason, but a reason is that these sigma 3 lines will contain 99+% of all trade activity, will be in between these two lines. And if you look back, you can see that that is the case all the way through, except for these spike days where we broke through it and then promptly reversed. Well, as volatility has increased, those bands have now started to expand. So now we can work ourselves higher. Corn's in a great uptrend. We identified this a couple weeks ago as it started moving. Everything is all systems go on corn. And I think that holds, we don't want to see it drop too far, I guess. But until something changes fundamentally, I think the market's just telling you got to sit tight and be very, very patient with it. All right, that's what I've got for today. Please call us if you have questions. If you're going to sleep better at night with some protection, let us know. And I'm not going to argue with people that want to that want to sleep better at night. But our advice at the moment is just stay patient and calm, because we're not quite there yet. As always, there is significant risk in trading futures and options. And if you're going to trade them, make sure you do so in light of your own financial condition and your own financial circumstances. Thank you and have a great week. We'll talk to you next week.